What's up, guys? This is Tom with StockedUp. It was a crazy day in the market today with the Fed meeting and with all the earnings going on. So I'm going to go ahead and give you guys a very good insight into what's going on with the S&P 500 and with the Fed meeting and everything like that. The Fed chair, Jerome Powell, went ahead and spoke today, and he went ahead and talked about how the coronavirus is going to affect the markets in the future. And he doesn't think that they're going to affect them too much yet, but he's eyeing it, and pretty much in the next quarter, he's going to go ahead and discuss what's going on with it. So as far as the coronavirus goes, he pretty much did not want to make a decision very early yet. He's going to go ahead and wait till the next quarter. And another big thing is that they left interest rates unchanged, which I believe made the markets go ahead and go down today. You can see right here on my screen, right here on this green line right here at 1 p.m. is right whenever the meeting was going on. So pretty much what happened is that the meeting happened, and then you can see the market kind of had this big volatility spike where it bounced right between these two SMAs, and then it went ahead and fell down here below. Now, a lot of people were expecting them to cut rates, and that's a big problem. Here, I'll pull this up right here. You can see this is the Wall Street Journal. They said that investors thought there was a 69% chance that the Fed would cut rates. Now, I don't know why the Fed would cut rates with the market being so high, unless they just wanted to fuel a very, very overextended bull market, which I don't think that they would do. Why would they want to fuel an overextended bull market or bull market and then risk having a huge crash happen? So I think that what they're doing is that they're creating a little pullback here, and it's something that, pullbacks are good every once in a while, just like you can see here how the market pulls back and then goes up, and the market will pull back again eventually. That's what happens whenever it becomes overextended. Every time it becomes overextended, it has little pullbacks like right there and a pullback here. Like there's just little pullbacks all over the place. You can see right here the market got pretty sporadic, but it did have a huge uptrend before it had this very big downtrend as well. And that's what they're trying to keep from happening. Whenever you have a nice, slow, steady market, that's just a nice steady thing going up. That's good for the markets. Whenever it's very sporadic and the volume starts to pick up, it gets scary for investors, and that's whenever they start to get out. So if we go back in time, back whenever the volume wasn't so sporadic here, see how the market just continually goes up with pullbacks, up with pullbacks, up with pullbacks, very small, slight pullbacks. And then now the market is having these big pullbacks and big overextensions. And this is what we can play on. Whenever you get into stat modeling and you start playing options, you can play these pullbacks and make 1,000% plus gains whenever the market falls like this. Mike just the other day made over $9,000 profit on BABA puts, BABA puts. Here, we'll go check BABA out. Here's BABA right here. You can see BABA went ahead and crashed the other day, and that's right whenever Mike had bought puts. Mike had bought puts on this day right here. You can see this, and then they crashed down here, and he made over 400% that day, and it was a very good day for him in the market. Very good day for everybody in stat modeling, really, if they bought puts that day, because all those puts went up. Now, if you got in late and you bought puts down here, obviously the market did go against you because it went ahead and came back up. But if you would have sold down here, you were going to be up about anywhere between like 400 and 800% on puts on BABA, and puts on, like, for example, another one today is Facebook is FB. You can see Facebook and after hours went ahead and tanked. So if you would have bought some puts today on Facebook, you could be up again 1,000% plus if you would have foreseen this happening, as long as they don't climb all the way back up by the time the market opens tomorrow, which I really doubt they will. Whenever you start getting crazy news about viruses and Fed meetings and then earnings in the market all at the same time, it's obviously going to create a lot of volatility and stuff like the S&P 500. And what that does is it just creates uncertainty in investors' minds, and that's why the market just continually just keeps going down now, because of all that uncertainty. And you can see that, for example, like Apple had very good earnings, but not every stock is having good earnings, guys. Apple had very good earnings, but Facebook, for example, very bad earnings. That's a pretty big drop here, 7% plus. That's a big drop for Facebook. That's going to make a lot of investors very sad, long-term investors. These things do happen in the market, though, and that's why you have to be ready for it. And a way to be ready for it is to play options. Don't just buy stocks alone, guys. Playing the options can help you really. It'll really help you whenever the market starts going down. Obviously, you can always buy shares whenever the market's going up, but you can't always short shares. Sometimes, the brokers might run out of the shares that they have available to short. So one thing you can do then is just go ahead and play puts. And the puts, for example, they might cost anywhere between $25 and $150 to $200, for example, depending on how high you want to go. But you'll pretty much just buy a put, and if it doesn't go up the next day, pretty much you're going to be down anywhere between 20 and 50% right away, depending on the expiration and how much it went down. But if you buy a lot of time with your puts and you play it very smart, and you wait for confirmations, kind of like we did. We waited for it to go down, and then we bought puts, and then we saw it go down even more, and then we got out. But that's the way you need to play, and you need to have the smarts and the vigilancy to do that. So don't play the options unless you think you have the skills necessary, because you need to be trading for quite a while to go ahead and grasp the concept of options. And practice makes perfect. So just go ahead and do paper trades at the beginning whenever you first get into options, and then take it over into your real account once you start seeing the profits add up. And that's what you should do. And the way to do that is to just every single day you can come up here to trade. And what you'll do is you go to trade, you'll type in whatever stock you want. You'll type in SPY, for example. Now the SPY, we'll go ahead and look at the chart. You can see SPY, for example, I bought a put today on SPY, and it went down here, and I hope it continues down overnight. So if we just go ahead and look at the puts, I bought a put that expires Friday, but you could buy a put that, this was today's, for example. These ones expired today, but this is the one that expires Friday. And then you can look at a chain that expires February 3rd or February 5th or next Friday, February 7th, I believe. And then you can just keep looking at all the different chains down here. And what you'll do is you'll pick a chain like this Friday, for example. Now these ones are going to be a lot more volatile, and they're going to go up and down a lot more than one would that's very far away, because they have a lot of something called time decay and implied volatility. Now implied volatility is something that I'll go ahead and pull up my chart again here. You can see implied volatility down here. That's pretty much whenever implied volatility goes up, that means that people are expecting a rise out of the markets. So whenever the market started falling here, you can see the implied volatility started going up. So that means that the options started costing more. So what that means now is that the options for the SPY cost more than they did last Friday. Now if we go to the options chain and we go to this Friday's, for example, like the one that I bought, because I'm hoping the market goes down by this Friday based on the Fed's decision and the Fed meeting. And I made a lot of money on the puts last week, so pretty much this is a risk-free trade, just buying a couple puts and hoping the market goes down. If it does go down, I'll end up making about 200 to 400%, I would assume, on those puts. But pretty much we'll go here, and you can see over here is the calls and the puts. So what we'll do is we'll scroll over here. Now guys, one thing you just always want to make sure is that you have your strikes are on all, so you can see all of your strikes. Your spread is on single, unless you want to do something else. If you want to do a spread or a straddle or something like that, you can go ahead and change the spread there. But I just like to go ahead and just buy the calls and the puts. So what you'll do is you'll just make sure you have your spreads on all, so you can see all the spreads. And then what you'll do is you'll just pick out your put here in the put column, and you'll come over here and you'll see, okay, this put costs the ask is 0.45 and the bid is 0.39. So you're gonna have to buy somewhere around the ask. So you can place an order. The bid and the ask here. So what you do is you go ahead and place an order somewhere right around the ask, like around 0.34, 0.35, or you could do even 0.33 and hope that you get filled. But the thing is that whenever it goes down tomorrow, you're going to hope that the SPY goes down and gets somewhere close to 321. Now, since you're very close to expiration, what's going to happen is that if the SPY then goes up tomorrow, you're pretty much going to lose all of your money. So you're going to lose pretty much $23 a contract, because the 0.23 means that it'll be $23 a contract. So you'll pretty much lose almost all the money on the contract unless you have a stop loss set. Now, if it goes down in your direction, you might make over 100, 200%, 300% tomorrow because of it being so close to expiration. But the thing is that if we go up here and we change our expiration, you can see these options cost more. So if we go ahead and look at a 321 again, these ones are costing $237. Now if we go back to the January 31st ones at 321, let's look at those. Those ones are only costing $33. So that shows you the really big necessity, or the really big reason you need to learn time decay with options, because you can really see that over time those options like to decrease in value, and naturally they do. And that's whenever you can sell call credit spreads, and since the options naturally decay in value, all you have to do is just hope that the option does not go up a lot in price. So what you'll have to do then is you can just sell the call. You can sell the call credit spread, come over to the charts here, and say, well, look, SPY, I don't think it's going to go back up to 33.40. So you can create an order to where pretty much you'll get paid. You can make about 10% if SPY does not hit 33.40 by this Friday or by next Friday, for example. But moving back onto the regular options, that's the biggest thing, is that the time decay can really kill you, because you can see that that option, it costs $231 for like a February 14th, for example, contract. But for a contract this Friday, it's only costing $30. So you can expect it to fall that much by then. And you can do stuff with that time decay, with those credit spreads and stuff, to help you out. But the thing is that whenever you're trading the regular calls and the puts, you have to be very vigilant of that time decay, and understand that, whenever you're closer to expiration, you're going to have a lot more volatility between your options. With the market falling, our plays have been working out very fantastically. Go ahead and check out statistical modeling. Link will be below. If you guys love options, check that out. If you love stocks, check out Stock Mastery. You guys can always learn options. There's an options course included in Stock Mastery, guys. You guys will love that. It'll teach you options, and then you guys can get into statistical modeling later on while you do the Stock Mastery stuff. As always, guys, if this video brought you any value, smash that subscribe button. Leave some comments down below. Check out that link to Stock Mastery. You'll really love it. If you love to play options, check out stat modeling. It'll really help you whenever the market's going down. You can make a really big, really high percentage gains on puts whenever the market goes down, and we call those out all the time. We love it when the market goes down. I know that sounds dumb to say, but traders love it when the market goes down. Trust me.